I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, February 12th, and welcome to discuss this week's markets happenings. And I'm delighted to be joined here by Alex Ambrose, who's CEO and founder of the Allocator Training Institute. He's coming to you from Dublin, and Alex and I have got to know each other on LinkedIn thanks to his great commentaries, and he did attend our live Markets Happy Hour podcast in Dublin. So Alex, great to see you again here.
Great to be here. Thank you so much for having me.
Well, as usual, I'll pull up the slides. I've called this week's podcast, Where is the Love? As we are on the cusp of Valentine's Day, and with some of the subsiding consumer sentiment, as well as the movement in markets around tech stocks and other sectors, increasingly just this week, the private wealth sector and some of the banking sector, I think it is a good time to question where is the love? And we may have a little bit of a Valentine's theme coursing through this. As usual, we talk about inflation, geopolitics, interest rates, equity markets, and other asset classes. And some of the sub-themes we have this week, we'll be discussing how inflation is remaining unpredictable, although it seems to be low and in control in Europe and other places. We'll talk about how consumers, not only are they not showing love, but they've been shown very little love of their own, as we can see that the labor market continues to show some contraction. We will look at the fixed income market and ask how bonds are continuing to play it cool with relatively low volatility and a calm demeanor as the rates look like they will be heading down, but we don't know when. We'd say, on the other hand, equity holders are a little bit more worked up, a bit more fickle and concerned about some of the sectors, and the big words on everyone's lips right now remains rotation. And then we'll look at some of the commitment phobia that may be in place around some of these, the sectors that I mentioned within equity markets. So here's Alex. He is CEO and founder of the Allocator Training Institute, which specializes, according to their description, in equipping professionals with the essential skills and credentials needed to excel in institutional investment roles. He's over 20 years of investment experience and is now based in Dublin. So welcome again, Alex, to see you. And we will kick off let's kick off with a discussion of inflation. So you're sitting there in Dublin. I'm in London. London has still not managed to, in the UK, get their inflation below 3%. I'd say in Europe, it's looking a lot more robustly below 2%. On the other hand, there are this discussion that anecdotally, we're finding that prices are higher. We've spoken about this in every single live Markets Happy Hour podcast that we've done. And I've got some quotes here these are US prices, but we're looking at beef costs being up 50% on pre-pandemic levels. Sales in restaurants slowing because they're feeling the pinch in terms of the food costs as well as the labor costs. And all of this is really equaling a pretty expensive consumer experience. So any thoughts yourself on inflation, what you're seeing, and how this is factoring into policy?
Yeah, absolutely. So a couple things I'd point out there's a hope amongst a lot of consumers, especially in the US, but also as well in the Europe, that inflation will not just slow down and not just get deflation, but also that we would get lowering prices. The problem is that once you have inflation starting to baked in, it filters through to so much of the economy, from the farmers starting up to the shippers, up to the grocery stores, to the restaurants themselves. And so the price level is something that, we're likely not going to have go back ever to pre-pandemic levels. The concurrent problem, especially in the US, as an example, is that the minimum wage has not increased in real terms for decades, whereas prices have continued to go up. And so something that happened commonly in the US was that people would be working two jobs just trying to make ends meet and then finding prices increasing. This is also happening not just at the grocery store and at nice restaurants, but also at fast food restaurants like McDonald's and Burger King. So the lived experience of people is that inflation is something that is here to stay. And even if it's slowing down, the price levels will never get back to something that they were used to before.
And that's a great point about labor, because it just happens to be the next slide I'm bringing up here. There was a concern that labor would be this lagging indicator, and that we would have, you mentioned minimum wage, not increasing, but that there would be some pressure. Some of the cities in the US have increased their minimum wage. And it does seem, though, that even now, inflationary pressures from the employment market appear to be easing. Of course, this is the kind of good news is bad news phenomenon that, the reason the pressures are easing is probably because some of those employment numbers are weaker. And I think just to move, keeping on the economic vibe check. So we've been speaking about the K-shaped economy for some time, concerned about the consumer at the lower end of the K, the kind of bottom right side of the K, the consumer that is not doing any better. And I thought it was interesting here. We've spoken about fast food decreasing, and some of the gainers, the beneficiaries of that would be grocery stores. And what I thought was interesting here is how Walmart, a very bricks and mortar grocery store, despite having had a reasonably good online presence, has massively outperformed Amazon over 5 years, according to the chart on the right, and then passing the 1 trillion market cap itself, as shown on the chart on the left. So I'd say between that and the consumer confidence being at a low, I think the market is telling us something here, or at least the economy is telling us something.
Yeah, it's really, I know the K-shaped economy is the common nomenclature, but I want to add a new one. I call it the W-shaped economy. And that is the difference between two different types of shoppers, particularly in the US. The ones that go to Walmart and get a lot of groceries and all sundry goods at Walmart, which are ubiquitous across the United States. And then the ones shopping at Wholefoods, which is on the very high end, much more expensive to go to. And it feels that there's two types of jobs and careers available in the US these days. The first is at the very low end of the economy, the entry-level jobs that are paying either minimum wage or not far from it. And then the higher end jobs, the finance, the consulting, the law, the jobs paying 100,000 plus to start. But those are increasingly not showing up as much either. And with AI and AI tools replacing a lot of the mid-level, entry-level jobs, this W-shaped economy, if you'll allow me to use that, I think is only going to continue.
Well, that is an intriguing notion. I will have to get that sketched at some point because I think and we'll actually talk a little bit about AI replacement later. And it does kind of get to that old adage that, well, it's not the plumber that will necessarily be replaced here. It will, or the welder, it will be the knowledge worker in the middle in some of these asset light companies that are knowledge heavy and asset light. And that's actually perhaps the most vulnerable piece. And I think if we remember during COVID, that was also a piece that was bulletproof in a way, because that was the piece that could easily be outsourced and done at home. So there was, in a way, that was insulated from any real economic pain then. But perhaps now is its time. So a really intriguing, I think, two-step or even three-step economy that's being discussed there. And just before moving on to get to AI and the challenges there, be interesting just to bring this back to interest rates, because obviously inflation and interest rates pretty inextricably tied together. And it's interesting to say that the expectations of rate cuts are still intact, despite the bit of a panic in the last weeks around the new Fed chairman who'll be coming in a few months' time, Kevin Warsh, suggesting that he could be hawkish, and that would throw everyone's expectations off. But equally, we've heard the ECB stalling on their rate cut trajectory, and the Bank of England stalling, but the Bank of England perhaps saying that the next move is down. Does this make sense to you that the expectations would remain intact? Do you
Oh,
see? Yeah.
oh, absolutely. So one of my favorite TV shows from the UK that was transplanted to America about 10, 15 years ago was House of Cards. And one of the key things you learn in TV shows like that are the political machinations behind the scenes of what we see in the news. And one of the reasons that Kevin Warsh was allowed to put out these contra views, that rates, maybe we're not going to decrease rates as quickly, was just to give some fodder to those who are currently believing that he is only going to do exactly what Trump wants him to do and be that voice for Trump, who wants lower rates immediately, which Powell has, rightfully so, stuck to the data and so therefore has not moved as quickly as Trump and his team would have liked. The key thing to remember is that Warsh was the alternative pick versus Powell when Powell was first put in place several years ago. And so Warsh now coming into the fore is something he's been fighting for years and therefore has changed his views publicly to be more in line with this administration. Critically as well, the jobs report that came out, there were two key data points that a lot of people noted, but which continue to reinforce the views that we're seeing here. The first of which is the jobs revision for 2025, which was almost a million fewer jobs in 2025. But a lot of people saw that more of a statistical update versus losing actually a million jobs. So the market wasn't as concerned about that. But what was really helpful were the other two data points of the jobs added, much greater than expected, and the unemployment rate actually ticking down to 4.3%. So this bodes very well for the Trump administration's view on how they're handling the economy. And it also allows Warshin team, when he gets into power, to continue the downward trajectory of rates. The only one bit of spice I would add there is a lot of people were contemplating whether Jerome Powell would stay on, as he's allowed to, after his term as chair ends. My view is he will not. Has only put out one short video decrying the pressure put on the Fed from a political perspective, but otherwise, I think he's going to retire to the, talking circuit in the sky, as most former Fed chairs do.
At the sky high per speech talking circuit, certainly. That's very interesting in terms of the signaling, I suppose, that was going on, because it is obviously in any Fed chair's interest to signal independence. That is will be a vote of confidence, I suppose, in the institution. And speaking of votes of confidence, we've spoken about this bond volatility and how it has been lower. And there is a bit of a sentiment out there around the current entry point when buying bonds. And this is something that I think our clients will be mindful of, is as they enter fixed income, are spreads simply too tight today? And is it basically better to stay at the short end today and wait until the spreads get more attractive at the long end or the medium end there? And that but I suppose my question is whether we can expect spreads to widen much. There's a sense that maybe some of the risk has moved into private credit. It's not in the public credit markets as much anymore. And looking at how calm bond markets seem to be, when we know that is the one sector that perhaps might genuinely scare policymakers if there were to be a panic in the bond market, it seems that bonds are quite calm. Any thoughts on fixed income as an asset class today and how we should profile it?
Yeah, absolutely. The first I would say is it still serves as a key income generator and volatility dampener for allocators all across the board. It's a way for them to defease risks. It's a critical part of any portfolio. But a couple of points that you bring up there reminds me of an old joke about the threat of nuclear war generally and its effect on markets. And the lesson that I was taught is if there's ever a threat of nuclear war, you should be a buyer. Because if there is a nuclear war, well, there's nothing really else to worry about. And since there is usually not a nuclear war, then markets will go back up. So therefore, the threat of nuclear war always becomes a buying opportunity in and of itself. Similarly, with the geopolitical tensions that have been happening for the last few years, what happened in Venezuela, what appears to be happening or happening in the next few weeks, maybe in the Middle East. A lot of things are happening in markets, but things are always happening in markets. But generally, the larger trends of asset flows, of demographics in the US, of investors are staying pretty straightforward. One key thing, one key metric that people talk about all the time, inevitably because it exists all the time, is markets are reaching all-time highs. And so therefore people must sell. But markets, equity markets in particular, they don't fall. There's not a recession, there's not a crash because of valuations. Markets and recessions almost always happen because of an overextension of leverage or some other unexpected exogenous crisis like COVID-19 happened for the few weeks that we had a mini crisis back in early 2020 in the markets. And so from my perspective, the lowering and the maintenance of lower volatility in the fixed income markets is expected because investors are continuing to plow money into something that is a key part of their portfolio, and the geopolitical tensions are pretty much expected. And you point out as well here, the Liberation Day, the increase in volatility, but then the acronym that people came up with, TACO, which I'm not always sure is true, but that Trump always chickens out. And he has pointedly pushed back on that sometimes. But the new tariffs or the tariffs that were taken off, depending on what day of the week it is, we could say which country, which economy, which person has had tariffs added onto them or taken off or changed. And so therefore the markets have kind of absorbed it and said, we can ride this out. Importantly as well, this is something that you got to put a large W in the Trump column for this because it really goes against the orthodoxy of the expected impact and flow through on tariffs into inflation. And we expected, everyone expected, I expected that tariffs would inevitably lead to a much higher inflation level. And there has been some impact, definitely, but not to the extent that everyone expected. And so therefore we've kind of absorbed, maybe there's a new orthodoxy that we need to consider, a new understanding of the flow through impact of tariffs. And so geopolitical concerns are always there, and the tariffs are going to come and go, but the market has kind of absorbed it and said everything is going along pretty much as expected.
Well, it's a fascinating segue there into politics and defense spending, actually, given we're speaking about wars and anxiety around that. Very quickly to touch on something else that didn't materialize as expected was Keir Starmer's demise. He still seems to have survived here in the UK, despite being involved with some Lord Mandelson and Epstein and just some general lack of, I'd say, popularity within his party, within the country. He's for now has not resigned. And it seems like there has not been elevated concerns. So we've not had another Truss moment in the UK in terms of gilts or the currency, although they have been weaker. And just on this defensive action, how this flows through, but we know we've come, Davos is a few weeks in the past now. We've had the various saber rattling around Greenland. We know that all of this, and even preceding this, did translate into strong flows into defense funds. We've been focusing a lot on European defense stocks, but I think it's important to also look at US defense stocks, which have been equally rising quite solidly, as the left chart shows, in excess of the S&P. And just in terms of the flows, where are the flows at this point? Really massive flows cumulatively flowing in to defense funds. And I think this will be part of our rotation discussion, because we've talked a lot about tech, and clearly there is overlap between tech and defense, but there does seem to be quite a bit of rotation into defense there. Another point to mention before we discuss rotation more broadly, just in terms of earnings growth, we did have a sense that this is a little bit small to be able to see this. This is in terms of where the earnings growth has come from. And what this chart shows is the light blue is where 50% of the revenue or less is from the US. This is for S&P 500 companies. And then the green one is where less than 50% of the revenues are from the US. So that the bulk is from outside the US. Earnings growth has come significantly from these exporters or companies exposed outside the US, which is, I think, perhaps certainly it's a message around the weakness of the dollar, but it's also a message around the robustness of that global trade and some of the US customers. So I have a few other discussions around rotations, but I'd love to hear your thoughts. So this is broadly, is this a US exceptionalism on the wane in terms of some of the rotations we're seeing? Any thoughts on the rotation away from tech, which this headline has called a US tech detox?
Yeah, you bring up a ton of great points. I'll just hit on a couple of them really quickly. First, I am impressed. Starmer is still around. The betting markets, Poly market in particular, has him at 50% out in the next few months. But based upon the support that he's received from members of the party, I think as long as the economy in the UK continues to stay steady and or grow, then he may be able to hold his spot. On the growth in spending from the US and from Europe in the defensive sector, that's exactly what I expect. And I think what everyone expects when they see in the US, for example, the US military budget on an annual basis is normally around 800 to $900 billion per year. And Trump has said recently that he'd like to get that up to $1 trillion. He likes big numbers, starting with a T, so that helps. That makes discretionary spending in the US as part of the budget much lower percent, and the ability for the US to have any fiscal maneuver because the amount they have to spend on entitlement spending and defense spending gives them almost no room to maneuver. Republicans used to be the party of smaller budgets and decreasing the deficit, but they've kind of thrown that out the window because the dollar's strength, it has been weak over the past year, but they don't see it going away anytime soon. In the Europe and particularly Germany, the enormous change philosophically of moving to increase drastically and also blow past the previous budget constraints on defense spending and spending generally is largely a reflection of the acknowledgement of the fact that their once strong and outstanding automotive sector has spectacularly imploded. Porsche, which used to have billions of dollars annually in profits, their profit dropped, I think, almost 90% last year. And most German automakers have recognized that their drastic coverage and success in China has now been completely eroded and maybe completely gone in the next few years with the rise of the Chinese automotive sector. So defense spending in Europe is not just a reflection of the concerns about what's happening in the Ukraine, but also a reflection of the fact that is a strength in terms of jobs and the ability to create larger impact in the economy that they could have otherwise from service sectors, which take longer to spin up, have much less of a flow-through impact for every dollar spent by the government. And then on the next slide, you were mentioning, sorry, the next one after this one. Yeah, you were mentioning what's happening in Japan. Sanae Takeichi just won the largest majority, but the key thing is for her and what she'd like to do in Japan. So the LDP has been in power since 70 years now, but the key that she would like, the founding mission of the LDP party, was to change the 1947 Constitution that was imposed upon Japan by the US government after the end of World War II. And a key to that is changing Article 9, which basically forces Japan to be a pacifist country. The problem that she's going to have is that even though she controls the lower house with a solid two-thirds majority, which would allow her to pass changes to the Constitution, she does not have as much control in the upper house, where she would also need a two-thirds majority. So a lot of folks think that she's going to take this to try to get some small wins to try to change some things in the Constitution. But Japan itself, as an economy and as a place to invest, seems like a focus of strength because, number one, the strength that she has to try to drive change in the country, the strength, particularly in the corporate sector, in the reduction of cross-corporate holdings from Japanese equity companies, which is nothing but bountiful, and also the push to get more women to have better strength in the corporate workplace and have better rights as women in the corporate workplace and in society generally. The one thing against Japan is long-term demographic issues, but that is a 20, 30, 40-year issue, not the next couple of year issue. So Japan looks like it's going to be very strong for the next few years.
That's fascinating. A return to womenomics. I think that was, as was
Oh, I
certainly,
love that.
yeah, it was a very interesting buzzword in Japan, probably 5 to 10 years ago. And you know, just in terms of the, it's getting a lot of attention. We're seeing this strong mandate, which has been unusual, I would suppose, in governments around the world to have that strong a mandate. I think we're describing this as this lack of indigestion around tech stocks in the US as a tech detox. And we've certainly seen that since the beginning of the year. And whether this is a great opportunity for the EU to tout its wares in terms of why it is an attractive investment destination. And of course, Japan as well. And then just finally to end the conversation, we've talked about no time to talk about metals today and Bitcoin. I think we'll leave that for another conversation. But I think it is important to discuss just some of this angst that has been creeping in to the discussion around technology, because we've seen, you know, the last few weeks, we've seen even the last few days, articles go viral, something big is happening around AI. It seems there is this sense, which is in this quote here, of sell first, see later attitude from investors. We saw that with software as a service. We also saw that just this week with altruist and the suggestion that the wealth management industry, my industry, was going to be completely disrupted and also financial sold off. So there does seem to be this knee-jerk reaction to AI kind of cascading through different sectors. And yet there is an old economy phenomenon, maybe your W curve there, where utilities, food, mining, construction, these cannot necessarily be easily disrupted by models that can now write thousands of words of code. So as you advise your clients in terms of rotations, depth, AI bubble, What are your thoughts?
No, it's fascinating that you bring this up. The one thing that we're seeing, everyone's talking about it, it feels like the AI tools coming to the market every day are speed running the tech adoption and impressiveness that we saw from prior tech adoptions. So for example, cell phones came out in the late 80s, early 90s, but it wasn't until the mid 2000s that they were kind of ubiquitous. Same thing with the internet. Been around since the 70s, 80s, wasn't really ubiquitous until again, 20, 30 years later. AI is taking a much faster approach to all of that. Seems like it'll be much bigger, but one key thing that a lot of people have glommed onto as professional investors, number one, is that the massive spending from these AI firms themselves, and also the AI adjacent firms that are adopting AI or using it, it's going to take a long time to get just a return on an investment, full stop. Secondly, and pointedly, what you have on the slide here, utilities, mining, construction, telecoms. An important piece for any of these AI tools to actually come into place in the way that they're all forecasting that they will is energy and the energy to power the data centers and the energy to power these AI firms to provide us with a funny video of Brad Pitt fighting Tom Cruise in a movie that doesn't actually exist but looks realistic. So a lot of what's happening in the professional investment space is yes, the AI story will be here probably for the rest of our lives, just like the internet has been for my entire professional investment life. But the investment opportunity at the moment, we want to kind of see who the winner is going to be. Is it going to be AOL or is it going to be Yahoo or is it going to be these other companies, Alta Vista or Dogpile? Turns out it was none of those. Turns out it was this upstart company. I always like to remind folks that Google, when they started in the mid 90s, was the 21st search engine. And it turned out they clipped onto something in their search parameters that was much better than what everyone else was doing. And it wasn't until the early 2000s, the mid 2000s, a decade later, that the rest of the market woke up to the utility of Google relative to the incumbents, which were seen as forever. And so the same thing is happening right now with AI, where the current incumbents that everyone's talking about, is OpenAI the next AOL? I don't know. None of us know. That's where I think kind of the wait and see approach is that we at least recognize that we might be early in deciding who the next winners are going to be, and therefore there might be other opportunities in sectors that support this. So it's the classic and useful and never-ending picks and shovels approach of we need to invest in everything else because yes, AI is going to be there, but we're not quite sure who the winner is going to be in that trade.
Sorry, a fascinating set of issues there, and I think certainly it's exactly this critical thinking that we say we will still need in the context of AI that we need to bring to this, a critical thinking perhaps around some of the trajectories and what we're seeing in markets with this kind of sell first, ask questions later, or check
Mm,
later. Perhaps there's a little bit of a aversion to just those large spending amounts. I mean, when we see just the amounts that are now ticketed to be spent on capex from the tech companies. I don't have a chart this week. I've had it in previous weeks, and we'll probably have it next week in terms of showing just that step change in capex expenditure. And where is that coming? Certainly, that is injecting cash into the economy. It's better than some of the share buybacks we've seen go on in the UK, which are not towards economic growth, but it is nonetheless going to come at the expense of other factors. Very, very quickly, definitely labor will not have the same expenditure, and we see that. And I think we are cycling through various doom loops according to the commentators that we listen to. Well, thank you so much, Alex, for joining us today to go through a wide range of issues. I will put a pin in your W-shaped economy and sketch it for myself and try to analyze things with that lens. So thank you for listening to the Markets Happier podcast, and thank you, Alex.
awesome. Thank you so much.